welcome. We're going to get started with our home buyers workshop. This is an intense 60 to 90 minute workshop, just laying out the foundations for our first time home buyers. And I'm just going to do a quick intro of myself, and then Cheetah, you'll go.
Sure.
My name is Catherine Ta. I've been a real estate agent since 2010, so I'm in my 17th year of real estate. I know, I don't look that old, right? But I'm here with mortgage broker Cheetah, who's I think I've been partnering with you since almost day one. So yeah, go ahead and introduce yourself.
Hello, everyone. Cheetah Metcalf. I am a mortgage broker at TNG, the mortgage group. I also started my career, I want to say 2010, 11, right? So around the same time. So let's say a decade and a half at least, been a mortgage broker. So our combined experience together, 30 years in real estate, even though we don't look a day
over 30 years.
Just graduated high school. I think we still have that youthful look.
We sure do. Okay. So there's going to be a lot to learn today, but we don't expect you to know everything. You just need to kind of know the foundations and the right questions to ask when you're ready. So it might be a little bit overwhelming with the information, but it's just to give you a little bit of a guide in what to expect and the lingo. Write down words that you don't understand or whatever. Ask in the comments, and we'll try and make sure that we get to answering those questions. All right, so let's get started. Let me change this a little bit. I'm trying to scroll and it's not scrolling because I'm looking on the wrong screen. Technical difficulties. There we go.
Good job.
All right. Okay, the outline today. Cheetah, do you want to go ahead?
Oh, to go over all the outlines?
Yes.
So we'll try to keep it within the 1 hour time frame, and we won't ramble on. We understand your time is very valuable, so thank you so much for giving us this hour on a Saturday morning. So we're going to go on the segments of, like, we think in the order that would be helpful in your transaction. We're going to go over, the difference between renting, owning, spend some time on that. Kathy will go over that with you. I'll go over the finance credit and savings, as well as the mortgage and pre-approval. And then back to Kathy, which once we get a pre-approval, I hand you back to Kathy. She will go and take you out shopping. And then after that, we are also, after shopping, we collaborate again for the mortgage approval, and then we can kind of prep you for the closing day and taking possession. And then I'll talk in the end about some of the programs and incentives that are specifically for first-time home buyers and things to be. So if you are planning on buying in the future, a lot of these programs are set up so that you are going to, build whatever the down payment or the foundation for the home buying in the future.
Yeah, you definitely want to stick around for that because those are going to be a great way to help you save up faster.
And start now.
Okay.
Like, start sooner than later.
Yes, start today. So I just wanted to talk about the true cost of renting in Alberta. Anytime you pay rent, you're paying down somebody else's mortgage, right? Building somebody else's equity. There's no equity for you to build. Every dollar out is gone. Okay. And in Alberta, rents rose actually about 28% since 2021. So everything is going up, right? And are you benefiting from it? Not really, not as a renter, right? So You get zero tax deductions for renters, and landlords can sell or redevelop your place at any time. You can't personalize your space, and every year you have to, there's a little bit of uncertainty as to, whether you can renew your lease or not. Okay. Now, on the other side, the 5-year Alberta renting math here. Okay. On average, your rent is probably anywhere from 1,800 to 2,200 for a family. Okay. Your annual rent, it's upwards of 25,000, and over 5 years, that's over $126,000 that you're just giving away, and you end up with no equity, no savings, and you're creating wealth for somebody else. So after 5 years, over $126,000 and owning nothing. Let's change that. Okay. Now, why owning wins in the long term? You're not only just building a basically adding money to your piggy bank, but you're also benefiting from the growth in home value, right? And you have a certainty in the monthly payments, right? With renting, you might have an increase every year. You have no control over that, right? There's also some tax advantages, and we'll talk about that near the end. And then you can customize your home. You can paint it. You can renovate. You can build some equity by adding value to your home. And having a mortgage is kind of like a forced savings account, right? You have no choice. You have to pay your mortgage, and part of that mortgage payment pays down your mortgage, which builds equity. Okay. And there's in Alberta, we have no land transfer tax, which is a big savings in terms of cost of buying a home. Okay. In other provinces, you've got a huge land transfer tax. Okay. So this is just a quick chart about the equity that you could build, so savings that you could build through owning versus renting. You after about 10 years, I think this was, you can save about 100,000 if you're really diligent. But if you were able to pay down your mortgage as well as capitalize on the growth of the home value over 10 years time, you're looking in the hundreds of thousands. All right. Cheetah.
Financial preparation. Okay, so so there's 3 aspects that when a mortgage broker does an application. So when before you go shopping, you talk to the mortgage broker about your finances, and you want to know what your budget's going to be. So a mortgage broker goes through the process of running numbers. But there's 3 main factors that we look at. One is credit. Second is down payment, which is your skin in the game, because this is an investment. And so how much are you coming to the table with? And then also, bear with me here. Credit, down payment, and then the property itself, right? We look at the property, and just the type of property matters to the lender as well. But so the credit is something that has to be something you managed, right? Your credit report is Equifax or TransUnion are the only 2 reporting agencies, but we mainly pull in Equifax. And so based on your credit history is what the lender uses to, I guess, judge on whether you're credit worthy. So how you managed your credit card, how you managed your car payments, and all the credit you've had in the past will indicate whether the lender will loan you hundreds of thousands of dollars for a purchase of a home. So, yes, home ownership is not an entitlement, it's still a privilege. So you have to earn the ability to borrow money. So when you're looking at this graph, based on the credit score, right? Typically we're looking, I'm looking for just the the I guess the yellow is just the entry into, like, getting into the prime lending space of good credit. And then once you're past that, then you've got the best rates available. Anything that's more the red and the orange, this is challenging, and so you're going to, in that space, require a larger down payment, and you're also going to get a higher interest cost. So how you manage your credit in the past will determine how much you end up paying going forward. So it's always a good idea, if you do have some challenge credit, work on, improving that. So credit scores are fluid. It's fluid based on payments towards your credit card, repayment schedules. And so as so even though you've had boost credit, you have the ability to recover. And so it's just a matter of having a conversation with the mortgage broker and kind of understanding what things that you need to do, and we can build you a plan. So next slide, please. Boost your credit and build your down payment. So if you're thinking about buying down the road, it's the two things that you can start like now is starting to save for your down payment, and managing your credit. How you pay your bills is very important. So if you look at this graph, paying your bills on time, the balance of your credit card, your utilization is very important. So we always try to, I say, do not, don't max yourself out. Try to keep enough room, because your score is just an algorithm. It's a computer that takes kind of a coding of how do we grade this person based on, what I mean, their repayments. So when they're looking at your threshold where you have one credit card and you're maxed, or you go over limits constantly, that will hit your credit score harder than if you had two credit cards and you kept yourself safely, let's say like 70% of the limit balance at all times. You can have the same amount of debt, but spread over two credit cards is far better than having everything stacked on maxing out one credit. Right. So there's some strategies that a mortgage broker can coach you through to ensure and to manage credit better. Don't close any old account. We look at history. The history, like an active credit card history is very important. If you close that, we no longer are allowed, you know what I mean? Like, it's no longer giving you the ability to add, add to your credit score. And because if you have a zero balance on a high limit credit card, that just shows that you have credit and you don't want to, you're choosing not to use it. Right. So you're not desperate. Right. So that's good to have. Dispute errors on Equifax. So it's often errors on an Equifax bureau. You can order your own bureau through Equifax or TransUnion. There's no cost, and it doesn't hit your credit score. Anytime a mortgage broker does it, or anyone, the banker or broker, because you are typically, when you sit down with us, we are trying to apply for credit, and any attempt to apply for credit in that credit pull, it will affect your score. So, but it depends on how often you pull as well. So if a mortgage broker pulls once, if you're doing what you're supposed to do in that month, it recovers. So like the points that we pull in that month will recover the next month, as long as you're doing what you're supposed to do. Okay. And avoid new credit 6 months before applying. Yeah. Don't open up car loans or take out debt before you buy a house, because again, it will affect your I guess, using your income to qualify for that mortgage. It takes away from the ability to we call it debt service, but it's called affordability. The more debt you incur on unsecured debt or car loans or whatnot, takes away from the size of the mortgage that you can qualify for. So you get a lesser house because you have more debt. Saving for your down payment. Programs are out there. The FHSA is probably the best one right now. It gives you the ability to write it off on your taxes, get money back, as well as the growth is tax-free. So it is a fairly new program in the last couple of years. It's $8,000 a year. And so what you have to do is you have to open it for it to allow the room to grow, because if you don't open it, then you don't have the kind of build of every single year growth. And automate everything. Even bill payments automate. If you're the type of person that forgets, automate everything. It's when it comes to technology, let technology help you manage your credit better. Whether you're automating your money into your savings or automating your bill payments, credit card minimum payments, automate those, because then you're not forgetting to pay it. Because one, 30, the credit bureau will track whether you're 30, 60, 90 days late. It is very meticulous. It is detailed. And so banks do judge harshly on that. And, so once you, yeah, automation, I think is you can be your best friend when you're trying to set yourself up. So there's TFSA right now. You can save up, it's tax-free savings. That's right now, if you haven't utilized that space, that does compound. So right now there's 109,000 room if you haven't contributed yet. RSPs, also, if you've been putting money away at RSP, you have the first time home buyers. It's a ability to pull up 60 grand per person to be able to come to use towards the down payment of the house, but you are required to pay that back over a 15-year period. And then gifted down payments, right? So you can get families to gift you down payment. And then 5% down is the minimum for owner occupied properties, and the closing costs. Please, save money for closing costs to pay the lawyer, legal fees, inspection. And there's a lot of costs to moving, like movers, and you might do some light renovations. It's just good to have extra money, not feel strapped. Don't feel stressed going in. Don't feel financially stressed going into a big home purchase. Build enough of a cushion so that you're not going to be behind the ball coming into a very big stage or milestone in your life. Next.
I've got a question.
Sure.
How do student loans affect lending, even if payments are regular and on time? Does it affect affordability still?
Yes. So the payment amount will. So if you have, right, like you have a $300 student loan payment, well, that's $300 that you're taking away from the size of your mortgage payment. So when you have a student loan, just off the top of my head, on a $500, whether it's a car payment, student loan payment, that payment itself takes away from nearly $100,000 worth of a mortgage. And that's a big difference between, like, that's a different house type, right? $100,000 difference. So having a student loan or having any debts, you're on a regular payment, but that just also means you have a payment, you have a liability, a payment that you are responsible for. That takes away from what you would typically, once you're done the student loan payments, that $300 payment now can get you a bigger mortgage.
Okay.
Okay.
So would you advise to pay off the student loan first?
If we need to. So typically when I'm talking to a client and I say, hey, listen, by the way, this is where this situation is at right now. You have it's a $300 payment for student loans. This is what you qualify for with the student loan still, balance owing and payment. But if you pay that off, this $300 can buy you this size of home. If the home that you want with the student loan payment is basically perfect and suitable for what you want, then don't pay it off. Because I know some student loans are, they're interest free, right? But if you are, that is a difference between, hey, well, I wanted to get a single family home, but that only, with the student loan, I can only get a townhouse. I don't want to pay condo fees, and that's not what I want. Then pay out the student loans. So there's options. I'll run the options, right? So it's just a matter of and you don't have to pay out the student loans right away. You at the time when you're making the decision and you go, buy a house, put in an offer, then at that point you say, okay, well, I need this paid off. When you find that house you really love, and you're like, I want a house, then you have to calculate that you have to pay off that student loan.
Okay, so in short, there is no one solution for everyone. So
it depends
it
on
might
what you
be
want to
advisable to pay it off for one person, but maybe not for the next person, right? Because
Correct.
it is an interest-free loan. You want to drag it out as long as possible.
Exactly.
Right? So, okay.
Down payment. So yes. So the down payment requirement is minimum 5% down on homes up to $500,000. Anything that's over $500,000, they'll do 5% on the 500,000 and then 10% on the above. So for example, on a $600,000 purchase, it'll be 25,000 plus 10,000, 35,000 for the down payment, right? And then 20% down. So anything less than 20% down in Canada, regardless of bank, institution, lender, you are required to have government default insurance. So it's CMHC. There's a couple of providers, but it is default insurance. You must pay that premium. The lender will lend you the money to pay the premium. You're still only required the down payment. That is not an out-of-pocket cost to you. And a mortgage broker, knowing how much you're putting down, will already calculate that into their payment. So when they're quoting payments, it's already inclusive of CMHC. Once you put 20% down, there is no CMHC requirement. So then at that point, rates are slightly different. Anything that's not insured, because lenders love government insurance. But that being said, the premium is pretty costly if you're putting down the minimum. So the more down is better. But yeah, 20% down means you're not paying that huge premium. Next. Mortgage pre-approval. So first step before you go shopping is getting pre-approved, meaning sitting down with the mortgage broker, providing documents, and then providing documents, and so I can set you out on a budget. So the terminologies that we're gonna go through, and you're gonna know about mortgages. So once you have a mortgage, there's two different types: fixed versus variable. So a fixed mortgage term. So typically a very common term. So let's say term is the contract time of a mortgage. Typically 5 years is the typical term. You get to choose whether your rate on that 5-year contract is fixed, so the payment never changes. The rate's slightly higher, but it's a guaranteed that payment will never change over the 5 years. So you're not concerned about the headlines of how the economy is doing and whether, whether rates are going up or down, because yours is guaranteed fixed, and you don't have to worry about that until the maturity date or when that term is up. The other option is variable, and variable is a floating rate. And it changes with the Bank of Canada announcements. Bank of Canada will makes 8 announcements a year, and it's using data. They use data on the health of our economy to determine whether we should increase or decrease rates in order to encourage spending or to scale back, right? So we're trying to battle the inflation. So we don't want, when you make money very cheap and very, interest is low, you're encouraging spending, but spending leads to more money chasing products and more. And what happens is you're pushing up the price of goods. So that is something that we don't want, inflation, right? But yet on the other end, if the economy, right, isn't doing very well, which is right now, isn't doing very well, you want to encourage spending, right? You want to push some more money out there so that people are out spending money, buying goods, because that's how we generate, growth. We need growth. Can't have a stagnant economy, right? So there's always the need for growth, but you don't want to have runaway inflation. That's the push and pull, why rates go up and down. So, but being variable is every time the Bank of Canada makes an announcement, you know that your rate could potentially go up or down. It's the uncertainty. Rates are typically, historically, variable rates are have kind of like gained weight in savings. But then the cost of that is the peace of mind, right? That you have, you've given away that peace of mind on a fixed rate to kind of, it's a little nerve wracking for some people who are on fixed incomes, right? So to be on variable rates. And so that's the gamble.
Next. And
go ahead.
Do you see people choosing, are there certain types of people that choose fixed versus variables?
So when we say types of people, my recommendation is, when you're a first time home buyer, I would want you to go into your first milestone easing, having a peace of mind and not being stressed out about, a rate announcements every couple of months. I would consider, because understanding that the mortgage lifetime of an entire mortgage is 25 to 30 years. It's a long game. It's a marathon, right? And they're broken up into these terms, contract periods of 5 years and less. There's less options as well. So you're breaking the entire life of your mortgage, let's say 30 years, and then you're breaking up into little slices of, these the contract terms, and you can change them every time you change a contract. You can go the first 5 years is fixed, just so you can get yourself acquainted with being a homeowner. There might be some outgoing costs. There's a cost of buying a house. Get yourself situated, and then after the first 5 year term, then maybe go to variable. Try the variable, right? So first time home buyer, no. But I guess try. So when you're a seasoned homeowner, you have extra money in the bank because you can weather the increases, right? So I typically would suggest, yeah, if you are more seasoned and you have money in the bank, and if you are still on your second term, right, and you're a seasoned homeowner, but you're on a fixed income and you're living paycheck to paycheck, I wouldn't suggest a variable interest rate, right? So again, it's the ones who have comfortable enough and with funds as cushions to go into variable. It's the gamble, right? And gamble safely. And also investors. My investor clients, I would recommend a variable interest rate. Variable interest rate carries the lowest penalty cost if you have to unload the property. So you're selling it just to get rid of it, as opposed to selling it to move and upgrade and moving your mortgage to a different property. Investors want to be able to, if the rental or the investment isn't doing well, to sell. It carries the lowest penalty at any time. So it's in variable rates for investor clients and clients who are seasoned and do have money in the bank account. Fixed is first time home buyer and people who are, who may need that certainty and cannot afford to have the increase.
Okay. And next question that I have that kind of goes with this rate thing as well is a lot of people shop for the lowest rate. What do you think of that?
So obviously, and I'm also a consumer. Like, I'm a mortgage broker, but I'm also a consumer, where you're right. It's very enticing online. There's tons of you know what I mean? Like dangling the carrot, low interest rate dangling. You see all these low interest rate sites. So anything to get you through the door. Number one, typically those sites are, they're difficult to qualify for, or the product is far inferior, right? To what's, things like they have clauses that are going to penalize you very heavily for that low interest rate. You can't pay down your mortgage, or there's a sale clause, right? There's you can't sell at a certain time, like the exit clause. And if you do have to exit, it is the cost savings you get on that, that interest savings is it's depleted, right, by these penalties for exiting, or whatever penalties they charge you. So the lowest interest rate isn't the best, because one of my specialties is spousal buyouts. I do, you don't plan divorce, you don't plan a marital breakdown, but it happens, and happens far too often. And sometimes you have to break mortgages and whatnot. So if you're in that, you know what I mean? So give yourself the flexibility of giving, you know what I mean? Having good penalty calculations, and just the ability to make some moves and pivot that aren't going to be costly when life happens. Unforeseen events happen. So don't always chase the lowest interest rates. And sometimes some banks are far more painful to deal with than others. They're not all the same. Yes. So
All right.
getting pre-approved in Alberta. Okay, so the pre-approval process, credit check. So, I'll do the credit pull. The mortgage will do the credit pull. The documents. So this is a pretty standard documentation. So we need income and down payment, and obviously we need ID, right, to confirm, the person who is borrowing money. So income is correlated, or the size of your home is directly correlated to how much income you make, right? So higher the income, less debt, right? Hopefully less debt. The higher the income can give you a bigger house. So income is the size of the house is directly reflective of that. So, and I can go up to 4 people on an application. So it's household income. not individual. So I can take everyone's income, everyone's debt, and do that calculation. So first time home buyers with new to Canada, I do also work with new to Canada, and sometimes you have to add whether it's multi-generational families that come in, and it's going to be what, mom, dad, could be aunts, uncle, grandma, grandpa, it doesn't matter, familial relationship. Once we can get all of them onto the application using all their income, we can get them into a bigger house. Okay, so I gather documents, calculate your budget, right? So the income, and then shop my lenders. So a mortgage, the difference between a banker and a broker, I'm a broker meaning I have multiple lenders that I work with, that I can get your mortgage through. You don't get the mortgage through TMG, the brokerage, you get the mortgage through banks. The TD, Scotia, BMO, I'm the one that can place you. I shop around for rates and terms that will fit your needs. Whereas if you go directly into one of those banks yourself, you don't have the ability to, with that one person, be able to shop and compare. So you're going to have to do the legwork versus you work with the mortgage broker. I do all that for you, and there's no cost to using a mortgage broker, right? And you're just saving yourself time. We do the same process. It is the exact same process with your banker that you do with the mortgage broker, but you're not having to go and do, multiple bank visits and multiple credit checks. And then I do a rate hold for you. So in an increasing rate climate, I know my clients are going to need, they're going to go shopping. I want to safely guarantee that I will give you a rate hold. So it's typically 120 to 130 days, right, to go shopping. If rates go up, you're protected. You have a ceiling. But if rates go down and you find a property, we can float that rate down. Whatever you were pre-approved at, not necessarily will be the lowest rate you can get, but it is the highest rate you're going to get, not the lowest. So there's no drawback to being pre-approved or getting a rate hold.
Okay. And it's definitely advisable to get a pre-approval before you start shopping. Actually, I don't really help you shop until you get a pre-approval, because with an offer, I needed a pre-approval to even put in an offer.
Yeah, don't set yourself up for disappointment, right? Don't go shopping without knowing your budget, and don't have your heart set on something and then not feel confident that you are going to be able to, take possession.
Yeah. And I just want to stress the fact of having a broker do the work for you and get your credit pulled just once versus going to all the banks and getting your credit pulled multiple times. That's not a good thing. And it's going to affect your credit.
Yeah, multiple banks, multiple bank visits, multiple people working on your application. Yeah, so, and some documents that your supplier standard and some aren't. So who knows? They're just, it's just time delays, and it affects your credit. How much can you afford in Alberta? So this is the threshold of the different household incomes that we have. So the combined household income these are the size of the home. So this is based on purchase price. And this is with the, I think, there's this disclaimer that it's based on 5% down and on today's rate. So current rate. So this slide itself can change if the rates change. So if the rates go up, then you qualify for less. If rates go down, right, then you can qualify for slightly more. But this will give you a good little, I guess, an idea of what range you should be based on your income. Next. Now that when I'm done getting a pre-approval for you, I hand you off to Kathy.
All right. So we've got our pre-approval done, and now we actually have a budget. And now we're going to define what our needs and wants are. And a lot of times my clients will have, a big list of needs, or actually wants, and we kind of have to shave some of it off, basically due to their budget. But I work with you and show you, if you want these big lists of things, then here's some neighborhoods that you might want to look into. But if you can minimize that a little bit, this isn't going to be your forever home. The average family will move around every 7 or 8 years. So, this is kind of your first stepping stone, so you don't need everything. What I would advise as your first home is buy something that you could possibly build equity in, something that's going to appreciate, and buying in good neighborhoods, especially if you have a family, would really be beneficial. And I'm always looking at resale value too. So if there's something about the home that might make it hard to sell later on, you might want to rethink that, and I'll tell you all about it once we get to that point. Okay, so we look at your checklist. I help you go through and create a search and recommend some neighborhoods, have you drive around those neighborhoods. And it's good to drive around during different times of day so that you know what the traffic is like. We take into consideration where you work, where you spend a lot of time, where's your extracurriculars. Sometimes you want to be close to family for childcare. All those things get taken into consideration when I help you set up your search, and the budget as well. I try not to push you to your maximum budget. I try to make it so that you're going to be comfortable with your monthly payments. So we have a desired budget, and then we have a maximum budget, and try our best to go to what you're comfortable before we move up. Okay. Once we've seen at least 10 to 15 homes, because as a first time home buyer, you really don't know what homes really look like. So, I try to give you a variety of options, and then we narrow down what suits you and your lifestyle. And then once we find a house we like, I look at the market value and will evaluate that and make an offer. Now, with this offer, you're going to, here's what's included in an offer. These are typical scenarios, right? All the appliances, if there's blinds, sometimes the curtains might not be included because they're easily removable, but typically blinds, when they're screwed in, anything that's screwed into the house, we can assume that they are included. And then there's the purchase price, which we'll go over. The possession date is typically within 30 to 60 days. Sometimes it can be outside of that, but typically it's 45 days-ish from the time of offer to the time that you get the keys. Okay. And the deposit amount. So when we write an offer, we also once an offer is accepted, we also have to provide a deposit. This is called earnest money, and it can be anywhere from 1% to 3% of the purchase price. Depending on the value of the home, we can probably get away between $5,000 and $10,000 as a starter home. Okay. And we want to make sure that the home is solid and that we are qualified for this home. So just because you have a pre-approval doesn't mean that you will get approved for sure. So the financing process isn't just making sure you're approved. We also need to approve the home. So once that offer is submitted and accepted, I'll fire this off to your mortgage broker and get that financing approved. And then we go ahead and book the inspection. We don't want to do this in reverse, because what if you don't get approved for financing? Then you've spent money on the inspection, right? So I always try my best to do financing approval and then have the inspection. We will typically get anywhere from 5 to 10 business days. So roughly 2 weeks is the norm, depending on the market. If we're in multiple offer scenarios, then we might have to shorten that. But in a regular situation, regular market, balanced market, you have time, and typically you have 2 weeks to satisfy the financing and inspection condition. The irrevocability period, when we put in an offer, we don't just keep it open. We give them a deadline for when we want this accepted for a couple of reasons. One, they don't have time to hold up for another offer. Two, so that, you're not stuck in limbo and you're still free to choose another home if that pops up within the next 1 or 2 days, right? So typically I will give them anywhere from 24 to 48 hours to accept our offer. And you can go back and forth a few times during the negotiation process until you kind of meet in the middle. I know that I've just had a client who said, I think it's in Nova Scotia, you're only allowed 1 or 2 counters and that's it. And I'm like, that doesn't make any sense, but that's how it is over there. But here you can go back as many times as you want, but typically within a set amount time frame. Okay. So negotiation tips, obviously I do the research for you and give you the information so that you can make an educated offer. Okay, and we'll go through all the terms and all of that, just to make sure that it works for you. Okay, inventory obviously in Edmonton, Calgary is a little bit tighter than the outskirts typically, but this year Edmonton has been a little bit slower than the outskirts, and it's been a real big change that I haven't really seen before. And again, counter offers are very, very common. During the inspection, you're going to find a big laundry list of deficiencies. And typically they're not anything that's going to be a game changer, because if you go to the next home, you're still going to get this big laundry list. So I don't care if it's a brand new home or a 15, 20-year-old home, you're still going to get a big laundry list of things to do. And these are just things that it could be very little, it could be cosmetic. But those aren't things that we're looking for. We're looking for big ticket items, possible water issues, electrical issues, the roof needing redone, that we couldn't see from the ground. These are things that we'll typically look for, but sometimes you can't see it, right? Sometimes you have to climb on the roof to see that. We'll always look at how old the furnace and hot water tank are, and the windows, are they going to be needing replacement soon? Those are some things that we look for, but things that we can't see are like foundation cracks sometimes, right? So the inspectors will have a moisture meter as well as the thermo reader, which will detect insulation problems or possible foundation cracks and water issues. So if you're lucky, we would have a big downpour just before inspection date, so that anything, if there were issues, it would definitely come up in the inspection with the thermo reader and the moisture reader. So keep that in mind. We want bad weather so that we can detect these, but it's not always going to happen. And then we always want to make sure that we never ever disclose what our top budget is, of course, right? Okay, back to this one. I guess I covered this already. Okay, the costs, I think I'm coming up. Okay. Costs of buying. Okay, this might be a little bit overwhelming. Okay. When you're buying, there's going to be a land title transfer fee as well as a mortgage registration fee. Okay. These are typically fairly low, but overall you want to budget about 1 to 3% of your purchase price for these things. So real estate lawyer, you're looking at $1,400 to $1,800. Home inspection, if it's a condo, for a condo, you're not inspecting the outside, right? You're just inspecting the inside. So it's going to be a lot cheaper. And then on the higher range, it's because you're buying a bigger home. So there's usually a set fee for up to 2,000 square feet, and then it goes up from there. So, you could be on, for the most part, for a beginner home, you're going to be in the $450 to $550 range for a home inspection. And title insurance protects you against title fraud or unknown liens on title, and also survey issues on a real property report. And a real property report, what that is it maps out your property line and any structures on within that property line, or maybe even a little bit outside. Sometimes that means, fences might not be on the property line and it might be outside. Now, if the seller doesn't provide this report, then we don't know, right? And if we don't know, then if something does come up, then the title insurance would cover the cost of remediating that issue. Okay. And then Cheetah also talked about the CMHC premiums if you have less than 20% down payment. And then there's property taxes. Property taxes this year is roughly 1% of your home value. Okay. So if you bought, in say June, just to make it easy, you would be responsible for half the cost of the annual property taxes. So it really depends on how much that is when what time of the year that you buy, because our property taxes are due June 30th. So if you buy after June 30th, then the homeowner would have already paid for that. So then you have to kind of reimburse them for, say from September on, if you bought in September, so a quarter of the year. Okay. And then before the lawyer will sign off on everything, you have to make sure that you have home insurance. So during that conditional period, you want to make sure that you go and shop for home insurance, just so that you know what the cost is, as well as there's going to be a lot of questions when you apply for that home insurance, and it'll be great time for you to ask those questions and discover it during the home inspection as well. Okay. Our possession day checklist. Okay, so when you meet with a lawyer, they're going to give you a call 1 to 2 weeks before to book you in to sign documents. They're going to tell you you need X amount of dollars to bring in, and this includes the lawyer fees, as well as your the remainder of your down payment, and a little bit extra just to cover any miscellaneous costs. And then once they deal with all the spreading out of all the money, they will reimburse you with whatever balance is left over. Okay. Before closing day too, depending on the type of property, especially if it's like tenant occupied, we want to make sure that we book in a pre-possession walkthrough at least 1 or 2 days, just to make sure that the home is cleared out, it's clean, etc. Okay. You want to make sure that you get your utilities hooked up, and there's tons of companies. You're not just limited to what's on the screen here. I've got a good utility rep that will go through with you and find you the best options for your situation. Okay. And home insurance, it's really hard to estimate home insurance because it's your credit is affected, and so it's really based on your scenario. So it's really hard for anyone to estimate what home insurance would cost. You'll also make sure you'll need to bring your photo ID to the lawyers because they have to identify you. And then at the end, once they, uh, spread out all the costs. Make sure that you look at your statement and make sure that everything is correct, because it's human. They're human on the other side, and there can be mistakes. And I've caught a few, but if the numbers look off to you, make sure you double check it. Okay. And then, oh, the big thing that I want to reiterate is, before possession date, do not buy any big ticket items. Do not change jobs that are not in the same line of work as what you were doing. No big car purchases, not until I hand you the keys, okay? Because, the day before possession day, the banks will still pull your credit. And if there's anything that's not, that wasn't in there before, could affect your possession date. They could pull your deal the day before. So make sure that you avoid doing anything drastic. And if you needed to do something, check in with your mortgage broker first. Okay. Now, after the keys, change your locks, because you don't know who's had access to it. And I love the wiser locks, because you can easily rekey the lock. So if you're lucky to get a home with a wiser lock that can easily be rekeyed, that would save you a lot of money. Let's see. One thing that might be a good advantage for you is to take pictures of your moving day. So if there's anything that like cracks in the walls or chips or whatever, at least you know that on move-in day, this is what it looked like. So when it comes time to sell, people are going to go, okay, how long has this been? Well, you can be like, hey, this was exactly the same as when I moved in, right? And the inspection report, make sure that you have a copy of that, because that will also really help to see what the condition of the home was when you moved in. And if you're in Edmonton or Calgary, there's different ways of paying your property tax, and it could be monthly, or with your mortgage, or yearly as well. So there's a few different options. I personally like just, having it with my mortgage. That way I don't have to think about it. Again, with Cheetah's comment, automation, if you don't have to think about it, then it makes life much easier.
Then no mistakes.
Yeah. And, meet your neighbors, create a community. It's really good to get out and take walks and say hi to everyone, because, we have a lot of situations where it always helps to know your neighbors, especially the ones next door. Okay. And then make sure that you have a savings for annual maintenance. Okay. Home ownership means you now have to do all the maintenance, right? So budget for that. And then celebrate. You're now an Alberta homeowner. So this could mean, tomorrow, or this could mean, the next 5 years. This workshop was to help you prepare for that. Now, here's the programs in details.
Okay, so I'll run through the program. I'm looking at the clock right now. We've only got, I believe, 7-8 minutes left. So I'm gonna run through these fairly quickly. I kind of touched base on them a few slides ago, but just we listed them in order of the most powerful savings, right? Most powerful saving tool, and then if you max that out, right, the other options as well. So first, home savings account, start now so that you can allow your room to grow. It'll save you money of the tax time going in and saving money on the way out. Your RSPs allowance, couples, so 60,000 a person, up to, so couples each, right? So you can do 120 grand out of your RSPs, but you have to pay that back. So this is a repayment back into your RSP, whereas the first time the home savings account is just meant for the down payment. And there's, once you execute or you use that program, then you no longer are eligible to use that program again. Right? With the RSPs, there is ability to, depending on situations down the road, a first-time home buyer is obviously allowed to use it, but then if relationship breakdown and you're resetting yourself to be, you have the ability to go back to use your RSP again. First-time home buyers tax credit. So this is something that your accountant will do for you and should do for you. So make sure when you the year that you buy your home, let your accountant know, I bought a home. This is important because then they will be able to give you it's a tax savings about up to $1,500. So it's a big, buying a house is it's a costly thing. So, but at least get some money back on your taxes for that year. Trying to ramble through this.
And I just want to stress, the FHSA, why it's such a powerful tool is because it combines the tax savings of an RSP and the benefits of a TFSA, where you withdraw without any taxes withdrawing. So they've combined the best of both worlds to create this first home savings account, right? You put money in, and that deducts from your annual income, and when you take it out, that's not considered income. So just all combined, those tax savings is huge. So if you start early, it's going to help you save a lot faster than just a savings account alone. Okay,
correct. It's a wonderful tool, and do now. You're planning on buying a house, open it. There's no, whether you're buying a house in 5 years, down the road, start it now. You don't have to regularly contribute to it. You should, but you don't have to. So that's the thing, is to open it, have a little bit of money there, even if you don't have a regular, deposit. It doesn't matter, just so that you can build it up. Okay, so
and the unused room can be carried over to the next year, right?
Correct. Once you open it, then it carries, right? But you have to open it first to be able to carry it. And what's great, and so it's anyone buying a house, please don't just leave your money in a savings account. Open that account. And then we have, the first time buyers GST rebate. So this is for any new homes, new built homes. You can go up to, $50,000 is available if you buy $1 million home, right? So in Alberta, typically first time home buyer, you're not going to reach that threshold typically. But there is an ability to, when you're the benefit of buying a brand new home from a builder, you get to save on that. And typically done as a rebate. So you end up getting it back at the lawyer's office, is what I'm seeing right now, because the builders aren't deducting it from the purchase price, because you have to qualify as a first-time home buyer, and they don't do the due diligence to confirm that. And then the 30-year amortization. So you are allowed to, as a first-time home buyer, now stretch your amortization out. So amortization, the term means the life of the entire mortgage. So it's like I said, a marathon. It's a long-term game. So before, you'd only have maximum when you stretch a debt over a longer period, means the payments are lower. And if the payments are lower, your income can qualify for a higher purchase price, right? So that 30-year amortization for first-time home buyer is now allowing people to get into a bigger purchase price than had it been 25 years. So that's a relatively new program as well. So the government is mindful of the fact that they want to encourage home ownership, and so these programs have been created relatively recently to get people into. The mandate is to get people into homes, not investments, into homes for their own primary residence. Next. Complete. Okay, the program summary. So we took those 2 slides and put them on here, showing you what the benefits are. And who can qualify. So if I just rifle through these quickly, so the first home savings account is first time home buyers only. Once you use that program, it's gone. You're not able to execute that program again. The HBP plan, which is the RRSP. So this one you can use. And then you have to repay it back, but you are still eligible if life changes for you and there is a marital breakdown, that you have the ability to access your RSP for a new home purchase. The next one is FHSA and the HBP combined. You can definitely combine this. You can pull out, you can max your, if your first home savings account, you only have 1 year, it's $8,000 and it's already maxed. Well, you need a bigger down payment, then you can access your RSP if you've been saving that for quite some time. Let's see, first home buyers tax credit. Your accountant will deal with that, but just advise your accountant you bought a home when you're doing tax that year. And then the GST rebate. So this is only on a new build, right? So if you're buying a resale home, you're not paying taxes. So you're not actually paying GST on a resale home. You're only paying GST taxes on a new build. So this is a GST rebate of the tax. Technically, there is no tax on a resale home. So that's why it doesn't apply to resales. And the 30-year.
There is a caveat to that.
Oh, is there?
If there is a possibility of adding GST if the home is substantially renovated.
Like it's a brand
so basically like gutted, and it's basically a new home,
like a new infill, a new home, pretty much. Yeah, you're right. And warranty will be required. So when you buy a brand new house, you have to have so every builder has to have new home warranty on that home, right? That's a requirement. And if there's a substantial renovation to a house, a significant renovation, then you need a new home warranty to sell that house as well. So it kind of resets you. So you're right. The GST apply and the new home warranty, just like it's a brand new build. And then the 30-year amortization we discussed, just the ability for first time home buyers. Anyone who, and even a marital breakdown you can access, because then now you reset the first time home buyers. Okay. So that's why we have the asterisk. Divorced are not owning for at least 4 years. So you can apply. So if you've never never owned a home, you sold a home 4 years ago and never owned a home since, you can now qualify for the home buyers plan. So some of those programs you can qualify for, but not all, just not all of them. Okay. Next slide. 10
All right, the big 10 mistakes first-time home buyers make, and we probably, talked about these throughout, but not opening the FHSA account immediately to start accumulating room. So do that today. If you are 18 and older, just open the account. Skipping the home inspection to win a bidding war. This doesn't typically happen for first-time home buyers. There's too many unknowns. It's kind of scary if you don't do a home inspection unless you have, a dad or uncle who is in the home building industry and they can, help you go through the home. Then it's less scary. But typically we will definitely have the home inspection in there. And then again, making those large purchases before you get handed the keys. Do not do that. And then forgetting to budget for that mortgage insurance and closing costs. It's not just the lawyer fees of up to $1,800 that you have to worry about. Make sure that you budget 1 to 3% of the home value for closing. And then wanting everything and not compromising. Again, this isn't your forever home. This is, it's a temporary, maybe a 7 to 8 year, maybe 2-3 years, before you start a family and you quickly run out of room. And getting pre-approved at only one lender, always shop around, right? For anything. Always shop around, and a broker will do that for you. So it saves you time and it saves your credit as well. Mm-hmm. And buying at the very top of your pre-approval budget, not allowing any room for anything that might come up, also not advisable. And again, changing jobs, your income during the mortgage application is very, very important, and it carries through all the way until you get keys. So I don't care if you change your job the day after you get keys, but do not do that before. And then obviously there's that GST rebate on a new construction home. Now, new construction sounds great, everything is brand new, but it typically still comes with extra costs after, because sometimes you have to get appliances, sometimes you get a small credit, or you also have to do landscaping and fencing. So that's not going to be your final price. You're already paying a premium because everything is brand new, right? But you also need to add on a few extras. And then choosing a neighborhood without visiting it at different times. So if commute time is important to you, we have a lot of construction going on in the city. So you want to make sure that you know what that construction timeline is and how it affects you and your commute.
Mm-hmm.
So your 12-month action plan, if you were looking to buy next year, this is what you would plan. And if you're buying in the next few years, start at opening your FHSA account, pay down credit cards, pay down student loans, minimize on car loans. Car loans is a big one, right, Judah?
Huge, especially when there's two in a household.
Yeah. And yeah, making sure that you start building your credit. If you have no credit right now, it's advisable to start, applying for credit cards and keeping that balance to within 30% of your limit. So if your limit is 5,000, keep it at 2,000 or less than 2,000, right? And pay it off every month. Okay. And then don't just pay off the minimum, because you're paying a lot of interest if you're doing that. Okay. And then, making sure that you have your income documents ready to go, because we need 2 months of incomes.
2 months of income, so documentation.
Yeah.
So to my typical documentation requirement would be just letter of employment, recent pay stub. We're looking for 2 years history, 2 years history of income. So when there's jobs that have wage or, when your income could fluctuate, whether it's commission, we want to look at the 2-year average is typically what we look for. So lenders will want you to, we want to see some history behind the job as well, right? So, and just a recent pay stub's good. That typically, but they could that's what's generally speaking, that's what we ask for up front. Lenders have the ability to ask for additional documents if they are concerned. So if your recent pay stub has less hours because you've been away on vacation, it's not doing the full-time 40 hours, and so you were light, right? Then they can ask for the previous, just to say what was the normal. If this was an anomaly, an exceptional, like an exception month, then maybe we'll go back to the last month of income, right? So they just want to find, banks love stability. They love guaranteed certain income, certainty, an income credit. So anything to show that's why we want to see history of income and credit.
Yeah. And now, since we have time, start touring the neighborhoods and see which ones you like and which ones you don't, and start checking them or crossing them off. So now is the time to do that type of research while you have time, during the summer, during the winter, what kind of activities, how's the, there's a walk score, how's the walkability, what do you have access to within walking distance? So that's really important to do. And then once you get to the time that you're ready to buy, then we go through that process of putting an offer, financing, inspection, and keys. Okay. You got this. We are here to guide you through all of it. And again, this was a lot of information and we don't expect you to know it all. We just wanted you to kind of know the process. And we're going to be here to provide you with all those details when you need it, whenever you need it. Along the way too, I always have checklists for each step so that you're not overwhelmed all at once. So, and both of us are fairly easily reachable. So anytime you have any questions, there are no dumb questions because we've heard it all. We've been in the industry for a long time. We've heard it all. So there are no dumb questions and that we haven't heard. I don't know. Have you had one lately?
No, to me, the questions, the dumb questions are the ones that aren't asked, right? The ones that you are still mulling over in your mind rather than asking. And a lot of times I find that the questions themselves are extremely helpful for us professionals because the often, like your situation and your life finances better than anybody else. It's your life. The more questions you ask me will give me the ability to probe more and understand your file far better. And then the more I know about your file and I can better recommend, right? So I'm using your questions as a guide. So continue to ask those questions. So you are getting information, but your broker is now assured that you know this information and whether that starts a conversation on getting, more details about you that would make me more effective as your professional. Right?
Absolutely. Communication is number one key to having a smooth transaction. There's no point in hiding any debt, any anything because we're going to find out, right? So having everything, telling us everything up front, good or bad, will help get you through it. And I'm sure you've had a lot of situations, a lot of tricky situations that you've had to deal with. And as a broker, with the experience, you just learn to overcome these roadblocks, I guess.
Yeah. Like I said, whatever challenges that you've had, it's not typically, it's very rare, that I come across something. I'm like, I've never really experienced this. But again, if it is, I have options and tools, right? But that being said, most people's situations is relatively common enough that we've already have gone through it and are able to help coach and maneuver and guide to be successful. So oftentimes when clients come to me and say, well, I can't buy a house. Like I just have bad credit and I'd like to already be defeated. When I say, well, no, that doesn't mean the all end all. Like you know what, with the proper guidance, we can turn things around. Your credit score is it's a fluid number. It changes every single month with every payment that you do make and every payment you don't make goes up and down. So because of that fluidity, then there is ability for improvement, right? Incomes do change. Hey, you know what? There's an ability to people have side gigs. Side gigs are income. That's income too. You don't think like your main job has enough income? Well, pick up a side gig, have that for a couple of years. We've just now got you into a bigger purchase price. So this guidance is what's going to help you, right? So the questions will help us, your questions to say, hey, how do I get a bigger house? Perfect. Allow me to guide you. Allow me to give you the tools, give you the information that you need in order for you to be successful. And that's, being a mortgage broker and a realtor, our time is, we're happy and we want to give you our time. We welcome, your questions. We want you to utilize us because your success is our success. We don't get paid until you close a deal, you buy a house, you take possession. Our time is to ensure and to help that you get to to where you need to be. So giving us all the information up front so we know what we're dealing with, right? And then we can get you to success because we don't we don't have a consistent paycheck. Our paycheck comes when you are successful. And so that's why we're happy to give our time to coach you so that you are the one who gets the key in the end of the day. Because yes, that's our livelihood as well.
And I get this a lot. People go, "Oh, I don't want to waste your time," and you're not wasting my time. Education is part of the process. So, if it means that, we need to see a few more homes, or we need to see a few homes now, even though you're not looking for till next year, to help you kind of figure out what your end goal would be, it's a good time to start planning now. It's a good time to start talking to Cheetah to have a financial game plan for your down payment. What does that look like? How long it's going to take? So that is it possible in 1 year, 2 years, 3 years, or more?
Yes.
So it's never too early to start talking to us. And don't be afraid of going, "Oh, I'm not ready now. I don't want to waste your time." You're not, because we love to educate, and we want you to do this right.
We want to start a long-term relationship. That's it. It's like, it's right. Buying a home, relationship with the realtor and a mortgage broker, because you will be dealing with your mortgage over a 30-year period, and because you're also going to be life upgrades and life, when you're living life, you're going to need the space to accommodate that life. You're going to be having a relationship with Kathy as well when you're going through the process of buying and selling. So that's where it's like, you're not wasting our time, because we're building a relationship, and having, it's never too soon to start talking to us, to get started, to get some information. And there's no such thing as over communicating. No such thing. I've never heard anyone say, "Hey, this is too much, too much communication. There's too many updates for me." Right? It's always the other complaint. I don't get enough updates. I haven't heard from my banker for a few days now. Right? So no, it's just, we love the communication, getting ahead of the ball as opposed to being behind the ball. So reach out and talk, and yeah, start the conversation now.
Yeah, I love over communicating. Even if there's nothing happening, I go, "Sorry, I still haven't had an answer," but letting you know that I'm still working on it, right? So you're never guessing.
Yeah, my update is I don't have an update yet. My update is I don't have an update yet, but you're top of mind. I haven't forgotten about you, right? Update is I haven't forgotten about you, but there's no update yet. We'll check in again tomorrow. Yeah.
All right. I think that was a lot of information. If anybody has any questions, please put it in the comments, or feel free to DM us, call us with your questions, and we'd be happy to work with you and, create a custom plan just for you, because there isn't one plan that works for everyone.
Sure.
Okay. All right. So signing off, my name is Catherine Todd with Real Broker.
Cheetah Metcalf with TMG, the mortgage group.
All right.
Saying goodbye.
Have a great day.
Did you end the stream?